let's talk through 163J. Really, this was from the Tax Cuts and Jobs Act. This limited how much interest expense you could write off on your tax return. So we didn't see it a whole lot, but we saw it for different operators and entrepreneurs who were doing roll-ups. So if they were using a lot of debt to go buy other companies and tucking them in, or we saw this also in partial ESOPs, if they had a lot of leverage, a lot of debt, and they weren't a full ESOP. And really the rule was saying that, hey, if you had over 30% of your EBIT, so earnings before interest and taxes, was on interest expense, that was the cap on how much you could write off in terms of the deductibility of interest expense on your tax returns. Now, with the new changes, it's based off of EBITDA, so 30% of EBITDA. So really, it's kind of a bigger number times 30%, which just means you can write off more interest. And then also $31 million small business threshold. So unless you're doing over $31 million of revenue, this doesn't even apply to you. Any thoughts or reactions on the expansion of the 163J?
I think it's actually going to be really good for anyone who has a lot of depreciation and amortization on their books. It's going to make a big difference for them.
Yeah. All right. Well, let's talk through Schedule A. I think this was one of the biggest changes on the personal side. And Schedule A is where all of the itemized deductions are taken. So as a taxpayer, we get to take the larger of the standard deduction, which is $15,750 now per person. Double that. It's $31,500 if married. Or the summation of all of your itemized deductions. And your itemized deductions is going to be your healthcare expenditures above 7.5% of your income. It's going to be charitable deductions. It's going to be your mortgage interest and also any investment interest. Anything else that's going to be on there?
Your salt,
state and local taxes. Yep, that's going to be on there too. So a lot of changes here. What are some of the biggest takeaways for you? And I think you maybe mentioned salt. That is the biggest change, which probably our entrepreneurs aren't going to feel a whole lot, but maybe walk through some of your biggest takeaways on these Schedule A or these deductions.
Yeah. So one of the big ones that I don't know, I guess it depends on the entrepreneur how big this is, but they are changing the charitable deduction. This is actually not benefiting the high-level taxpayers. Yeah. So every taxpayer, there's going to be a 0.5% adjusted gross income threshold. So everything up to 0.5% of your AGI, you get no benefit from giving to charity, right? And so to put some numbers to that, if you had $1 million of adjusted gross income, that means $5,000, your first $5,000 of charitable gifts do not help you. By the way, this starts in 2026. Mm-hmm. That's why giving this year is going to have more benefit to virtually every taxpayer than giving in 2026. And remember, you have to itemize for this. But in 2026, it's the 0.5% threshold, but also the most deduction you're going to get. Remember, the highest tax bracket is 37%. Starting in 2026, if you're making more than a little over $626,000 if you're single or $751,000 if you're married filing jointly, you go into the 37% bracket. When you're in those brackets, you do not get a deduction more than 35%.
Yeah.
So it limits them both ways. And one thing, a planning opportunity is think about doing a donor advised fund where you can get the deduction this year and then give the money out over a period of time in the future. Yep. So then that's before you have the 0.5% AGI floor. It's also before you have the 35% limit on your deduction. So that's one of the big ones. I don't know if you have thoughts on that.
I totally agree. If you're tithing, if charitable giving is ingrained into something that's very important to you, that's how you're going to get around this 0.5% AGI floor for the new charitable deductions. You're going to use a donor advised fund. You're going to do what's called clumping and lumping. You're going to want to put 2, 3, 4 years of charitable contributions in 1 year, and then you can disperse the money to your church or tithe or whatever you want to do over those next 3 or 4 years. But that's how you're going to get around it. So we're going to see a big intake or big uptake in our donor advised funds there. The other thing that I think was interesting was the state and local tax, the temporary relief there. And so really what this goes back to is when Trump redid the tax code in 2017, he capped the amount of state and local taxes, so think property taxes and income taxes, that you can write off on your personal return at $10,000. And the idea being here is it says, hey, well, should the federal government be subsidizing the taxes you're paying at your state level? And so they essentially capped at $10,000. Well, what's happened is that there were more seats picked up by Republican at the House in blue states like New York or California. So those are high state income tax states, but they were Republicans. And since the Republicans had such a narrow margin in the House, these Republican essentially House members in Democratic states had leverage. And so they said, hey, we need to bump that cap up because constituents in my state are paying a bunch in these taxes, and I want them to be able to write off on their personal tax return. So how did they kind of work this out?
Yeah, well, they created a $40,000 cap instead of a $10,000 cap, but there's a phase out. So the phase out is between $500,000 and $600,000 of adjusted gross income. And when you're in that $500,000 to $600,000, and this is true whether you're a single or married filing jointly, there's a tiny bit, but really for virtually all taxpayers in that $500,000 to $600,000, as you're phasing out, every dollar you make between $500,000 and $600,000 is like you're getting taxed on $1.30 for every dollar. Mm-hmm. So what that means is from $500,000 of adjusted gross income to $600,000, your SALT deduction goes from $40,000 to $10,000. In that space, your federal, not your state, your federal tax bracket is 45.5%.
Ouch.
So that's why it's so important if you're right around that $600,000 to find ways to reduce your adjusted gross income to $500,000, because that'll save you a ton in taxes. That's a huge benefit right there. So sometimes entrepreneurs say, well, you know what, why do I care about, I'm in the $10,000, why do I care about this cap? Because I don't have any state income taxes. So let's say you live in Florida, Nevada, Texas, one of the 0 income tax states. Mm-hmm. And I say, well, do you own any property? Oh, yeah, I do. Well, what about property taxes? That falls into the SALT as well. So think about that phase out. But the other thing that they left in, this is what I wanted to mention, is the PTET, the pass-through entity tax. And that allows you to pay your state income tax directly from your entity, if you're a flow-through entity, and not have it show up on your 1040. So in essence, you get to deduct 100% of your income taxes for your flow-through entity.
Yep. If you are a S corporation or a partnership and you are not paying your state income taxes through your business, you're doing something wrong.
Yeah.
That's the bottom line right there.
That could be costing you hundreds of thousands of dollars.
Yeah, especially in California.
Yeah.